Hi, good afternoon, everyone. Welcome back to today's session of the weekly market review. My name is Gerald, and I'm happy to be sharing with you some of the key updates on the market once again. Sunny is away this week, so I'll continue to be sharing some of the fundamental analysis. And then when he's back in January, we can continue to go through the technical analysis on the markets. Okay, so as usual, we'll start with a disclaimer that today's sharing is for information purposes only, and it should not be taken to be financial advice. We have a SIAS session that is coming up this Wednesday, 13th of December. This is a session that is exclusively for SIAS member. So if you have got further questions following today's weekly market review, do join us on Wednesday, where you will get an opportunity to be asking further questions around whatever has been discussed. Sunny will also be joining us on Wednesday. So if you've got any technical analysis questions, do join us this Wednesday. And this is a link for you to leave us a review on Google if you find the webinar helpful. If you're wondering how you can join SIAS as a member, you can go to this website or scan the QR code. The membership for SIAS costs just $12 per year, which will work out to only $1 per month. Okay, so we'll start the session with some good news. What we see here is that the S&P 500 has actually reached a high for this year, closing above the 4,600 levels. Okay, likewise, the Nasdaq is also at a year-to-date high of 14,404 after it gained a further 0.7% in the past week. What we also see is that the STI is finally starting to catch up. Okay, the STI, after having a few weeks of losses, is now up 0.7% for the past week and actually closing above the 3,100 level. So some of the positive sentiment around the US market is finally translating into the improved performance for the STI. Okay, so what are some of the key macro indicators that are actually quite helpful? We start with looking at this 10-year government bond yield. Okay, it's something that we've been talking about every week. So it's good to have a constant refresh around where we are at this point in time. So what we see here is that in the past week, it has been at about the 4.2% level. This is after it's come up very sharply from 5% just in October this year. And the fall in the government bond yields is actually what has lifted sentiment towards the US market and in particular the tech stocks. Okay, so this is something that we'll continue to keep a close lookout for, especially with the consumer inflation data coming out this week, as well as the last Federal Reserve meeting for this year. Okay, so some of you who are gold investors might probably also have realized that gold actually reached a record high last week. Okay, at some point, it was actually above $2,100 per ounce. Okay, so this has actually reflected rebounded very strongly from once again October this year. And that is really driven by two key factors. One, if you recall, there were some concerns around an increase in political tension in the Middle East. So as usual, gold is the safe haven asset. And we saw this bounce towards October, driven by the shift in assets towards a safe haven like gold. But what we have also seen over the past 1 month is that as the 10-year US government bond yield came down, the USD has weakened, and with that, gold price has also gone up, such that it touched a record high last week at above 2,100. But since then, it has come off a bit slightly. So this is something that we'll continue to monitor as to whether the fall in the US government bond yield, whether the weakness in the USD will continue to lift the price of gold. Okay, and the next thing would be oil price. This is something that has come off sharply. So effectively moving in the opposite direction of the gold price, effectively falling to below $80 per barrel. So first and foremost, I think some of the concerns around the geopolitical tensions have eased a bit, given that we have not seen an escalation of the tension. And then on top of that, we have seen actually some forms of demand weakening for oil. Last week, there was the inventory data that came out, which showed that inventory has actually grown a bit more than expectations. So that is actually driving the weakness in oil price that we see today. Okay, so you see quite different charts across the 10-year US government bond yield, gold price, which is actually reaching multi-year highs. But then on the opposite side, you actually see oil price moderating quite significantly. So how has that actually impacted the Singapore market? We see that there have been quite significant volatility across the different stocks. Seatrium, as an example, was actually up about 7% last week. So this was a stock that we discussed the week before. If you missed it, do go back to the previous weekly market review, where we gave an update on Seatrium and what are some of the things to be looking out for. The other name that had a very strong performance last week was Genting Singapore, up by 6.5%. We see the REITs continuing to do well. Mapletree Pan Asia Commercial Trust up 2.9%. CICT up by 2.7%. Okay, so these are some of the names that we'll discuss in more detail later, especially Genting Singapore and Mapletree Pan Asia Commercial Trust. In terms of the worst performers, we have SIA down by 0.2%, DBS continuing to be weak, given the fall in the government bond yields. This is something that we discussed in the previous week as well. So if you missed that, do go back to our previous weekly market review. Okay, Keppel Corp, after a strong week of gains in the previous week, retreating slightly by 1.2%. And then we've got DFI Retail Group down by 3% and Sembcorp Industries down by 4.8%. Okay, so what are some of the key news that are moving the market? Just now we shared that Genting Singapore had a very strong week of gains. So effectively, it reached a 6-month high. This is really after Singapore and China announced that they will establish a 30-day mutual visa exemption agreement. Okay, so helping to lift the sentiment towards hopefully having more tourist arrivals from China into Singapore. The next one, I'm not sure whether is it considered good news or bad news, especially if you are a common taxi consumer. Okay, so ComfortDelGro will raise the flag down fares by 50 cents for its regular taxis, as well as the distance and time-based charges starting from the 1st Jan of next year. Okay, so this is really intended to help the drivers defray some of the higher operating costs due to rising fuel prices, high inflation, and the upcoming GST hike. Next, we saw Mapletree Pan Asia Commercial Trust being one of the top gainers in the STI last week. So this is really because the 10-year government bond yield remains under pressure and the REITs have outperformed as a result. Okay, so we'll start by going through Genting Singapore. So I shared earlier, it is effectively at a 6-month high, now back to almost $1 after falling to as low as close to 80 cents just about 2 months ago. Okay, so what is driving this volatility in the share price? You actually see that it went up to as high as 120 around April this year, came down sharply, and then recovered over the last 2 months. Okay, so what we'll do is we start by looking at the earnings. As investors, it is important to understand how a company's earnings is trending. And the good news for Genting Singapore is that the earnings has actually recovered very strongly. If we look at the 3rd quarter ending 30th September, the company generated about 216 million of profit, and that is actually up 59% compared to the 3rd quarter of last year. So what we see here is that the gaming revenue grew strongly by about 20%, but the non-gaming revenue also up very significantly to 230 million. So I think as the tourist recovery continues, that has helped to boost both the gaming as well as non-gaming revenue of Resorts World Sentosa. Okay, so if you recall the chart that we shared earlier, effectively what we have seen is that Genting Singapore reached a very high price of close to 120 in April. Then thereafter, it came off slightly before the rebound over the last few months. I think we can effectively track the tourist arrivals into Singapore to get an indication of the sentiment towards Genting Singapore. So what we see here is that the number of tourist arrivals into Singapore has improved, but then at the same time, because of the slowdown in Chinese tourist arrivals in the last 2 months, it has effectively tapered off a bit into September and October. So that might be one of the reasons why Genting Singapore actually saw the weakness in the share price from the high sometime in April. But what is effectively helping to boost the sentiment once again is because of the strong results that we saw earlier, plus the fact that the news of the easing of visa requirements of Chinese tourists, and the hope that we'll then see more tourists coming back into Singapore once again. Okay, so how important are Chinese tourists to Singapore? So this is effectively a chart I put out from 2019. And what we see here is that actually the mainland Chinese tourists are really the big group of who will make up the bulk of the tourism receipts in the Singapore market. Okay, so back in 2019, if you look at the breakdown, the receipts from mainland Chinese tourists would actually be number one amongst all the different markets that they come from. So that effectively shows how important Chinese tourists are to the Singapore tourism market. And if I were to look at how the trend in Chinese tourist arrivals have been, to extend this prior to COVID, so going back to December 2019, what you see here is that, say, in December 2019, there were about 340,000 Chinese tourists coming into Singapore back then. With COVID, it came down to very low levels. And then with the gradual reopening, we saw a recovery in the Chinese tourist arrivals back to above the 300,000 levels in July. But as we saw, based on the overall tourist arrival numbers earlier, the number of Chinese tourists actually came down in the last 2 months, such that in October, it was just over 100,000 arrivals from mainland China. So I think that is what has brought down the overall tourist arrivals into Singapore. And that is what this change in the visa agreement would effectively hope to be able to reverse. Okay, so this is effectively boosting the sentiment towards Genting Singapore, with the hope that there'll be more tourist arrivals from China coming into Singapore. So if I look at some of the other valuation statistics of Genting Singapore, it is now offering a dividend yield of 4.1%, which is above the historical average. And this is really driven by the expectation that with the higher profit, the company will be able to pay out a higher dividend. Okay. Next, we will look at ComfortDelGro. Okay, another stock where the share price has been fairly volatile. So effectively, it fell quite sharply towards the middle of this year, down to actually close to $1 per share, which is effectively the all-time low, and then effectively recovering now to about $1.35. Okay, so what is actually helping to boost the sentiment towards ComfortDelGro? Okay, so in case you have not really been following ComfortDelGro, I just have this breakdown of where it generates its revenue. So for many of you who are taking ComfortDelGro taxi using public transport, you'll probably be familiar with the company. And truly, Singapore would make up the bulk of its revenue. Okay, effectively, more than half of the revenue of ComfortDelGro would come through from the Singapore market. Other key markets for ComfortDelGro include some of the overseas ones like UK and Ireland, Australia, China, and then a small part coming from Vietnam and Malaysia. Okay, so once again, we look at the earnings profile of ComfortDelGro. I brought up the comparison of the first half of 2023 versus the second half of last year, as well as the first half of last year. So what you see here is that revenue came off slightly from the second half of last year, but it's still up compared to the first half of last year, but generally quite steady because as a operator of this public transport, we don't see it being a very cyclical industry. So if I were to look at the operating profit, effectively the operating profit is down slightly compared to the second half of 2022. 43 million operating profit in the first half of this year versus 44 million in the second half of 2022. Okay, so generally quite stable, but we see effectively that the operating profit has come off slightly. But what the company has effectively done is that they have updated their dividend policy, and what they have told investors is that they will pay out at least 70% of their profit after tax. What we see here is that in the past, they've generally paid out about 70 to 80% of their profit. And this is despite the previous policy to be paying out at least 50% of the profit. The only exception, of course, was in 2020 during the COVID period, where because the company was being more prudent, they did not pay 70% of their profit after tax. Okay, so what the company hopes to do is that with this new payout guidance, it will provide more certainty to shareholders around what dividend they can expect from the company. So this is a trend of ComfortDelGro's dividends. What we see is that between 2008 and 2017, it has effectively been growing steadily. Then I guess with the competition coming through from some of the private car and ride-hailing companies, the profit came down and the dividend also came down with a very significant drop in 2020 because of COVID. But since then, having recovered, and in the last year, they managed to pay out a special dividend as well. Okay, so if I look at ComfortDelGro today, dividend yield of about 3.7%. Last year, they had a special dividend which helped to boost the dividend yield. But effectively, that is something which, based on the dividend policy that they have shared earlier, provides some certainty in terms of what kind of dividend payout to be expecting. Okay, the last name that I wanted to go through is Mapletree Pan Asia Commercial Trust. One of the names that we get asked fairly often. So like with most of the REITs, we saw that the share price came off through the bulk of this year. And then with the lower 10-year government bond yields, we started to see a rebound. And for Mapletree Pan Asia Commercial Trust, from a low of about $1.30 per share, now back to about $1.42. Okay, so I'll just quickly run through the key assets of Mapletree Pan Asia Commercial Trust. Some of the assets might be very familiar to you. So VivoCity are really the core asset that Mapletree Pan Asia Commercial Trust has, making up about 20% of its entire portfolio. You also have got Mapletree Business City MBC making up about 23% of its portfolio. And then after the acquisition of some of the Greater China assets, Festival Walk also making up now a significant part of its portfolio. If I look at the breakdown across the different asset classes, retail makes up about 46%, and this really the contribution from VivoCity as well as Festival Walk in Hong Kong. Office is about 28%, and then business parks at 26%. Okay, so this is the revenue and distribution trend of Mapletree Pan Asia Commercial Trust. What we see in the second quarter of fiscal year 2324, which is effectively the quarter ending September, is that the company has still been able to grow its gross revenue. We'll see later that that is because of the occupancy rate that it has, as well as the positive rental reversions. So 10% up compared to the previous year. We also see an increase in its operating expenses, mainly the utility expenses, close to doubling over this period of time. So that is a reflection of the higher electricity prices compared to the previous year. But overall, actually, the net property income is still up by about 9% compared to the previous year. The other thing that rose very significantly is the net finance cost, which was up by close to 38%. So effectively, that has actually led to the fact that you have thereafter the net property income not being able to contribute as much towards the distribution per unit for the unit holders. Okay, so that's why when we see the amount available for distribution to unit holders, it is about flat compared to the previous year. And then when you take into consideration the fact that the unit holder base is now higher, that effectively led to a fall in the distribution per unit compared to the previous year. Okay, so this is the trend of the occupancy rate. What we see here is that if you were to look at the occupancy of VivoCity, that continues to be very strong at 100%. Likewise, Festival Walk in Hong Kong also at 100%. Okay, for MBC in Singapore, what we see here is that it is higher compared to the previous quarter, now at 96.8% compared to 95.9% in June 2023. Okay, so overall, the portfolio occupancy for Mapletree Pan Asia Commercial Trust has increased to 96.3% as of 30th September compared to 95.7% as at June this year. If we were to look at the rental reversions for the entire portfolio, it has still been able to generate positive rental reversions. So that is mainly driven by the strength of the Singapore assets. So VivoCity, as an example, 14.2% rental reversion, MBC 7.1% rental reversions. But this is offset by the weakness around its Hong Kong as well as China properties. So Festival Walk, as an example, the rental reversions were actually down by 9.5%. Okay, but overall, we see that the portfolio is still having positive rental reversions of 3.2%. Okay, so earlier we saw that a big factor driving the weakness in the distributions is because of the increase in finance costs. So if you look at Mapletree Pan Asia Commercial Trust, the aggregate leverage ratio is at 40.7%. As at 30th September 2023, okay? So I would say that this level is probably higher compared to some of the other REITs, where on average, we see that the average aggregate leverage ratio is at about 40%. Okay, for Mapletree Pan Asia Commercial Trust, now they're fixed about 80% of their debt on a fixed rate, and the average term to maturity of the debt is at about 3 years. Okay, so this is something that we'll continue to keep a lookout for in terms of whether we'll see an increase in the aggregate leverage ratio, and whether that will also translate into a higher finance cost for the company. Okay, so if you look at the valuation of Mapletree Pan Asia Commercial Trust, now the price to book is at about 0.8 times. Okay, still below the historical average, but having recovered slightly from effectively where it was just a few months ago, when the price to book ratio was maybe at about 0.75 times. If you look at the dividend yield of Mapletree Pan Asia Commercial Trust, the expectation is that the forward dividend yield is at about 7.7%, and this is above the historical dividend yield of 5.9%. Okay, so I've gone through 3 key stocks that have had significant movements in the past week. We have a few things that we need to look out very closely for this week. Number one, we have a number of inflation data coming out from the US. So that will include the CPI on Tuesday, 12th December, as well as the producer price index data on Wednesday, 30th of December. Thereafter, we have the Federal Reserve meeting, the last one for this year, where we'll get an indication on the Fed's interest rate movement, which will once again have an important impact on the government bond yields. Okay, We have the SIAS session on 13th December as well. So do join us for the session to have your questions answered by Sunny and myself. And last but not least, if you want an update on the earnings season, if you want to get yourself up to speed around what is the outlook for 2024, SIAS is organizing a session this Saturday on 16th of December, where we'll help you to understand how to navigate market volatility. You can find more details of this event on the SIAS website. So do join us this coming Saturday, 16th of December, and I hope to be able to see you in person then. Okay, so have a good week ahead and hope to see you on Saturday. But in the meantime, stay safe investing, and I'll see you once again next week through the SIAS Weekly Market Review. Thanks so much for joining us today. Thank you.